Hello, everyone. Good evening. This is Antonio Andreoni from the Institute for Innovation and Public Purpose at UCL. And tonight we are going our regular seminar series event with Professor Daniela Gabor. We will wait a couple of minutes to allow people to get into the room and see people start getting in. And we will start immediately after. I also welcome Josh Ryan Collins, also from IIPP, who is going to be acting as a discussant today.
Hi, Josh.
Hi, how are you?
Cold in your house.
Yeah, it's very cold. Yeah, probably a bit over the top with mine.
No, it's okay.
I'm it's not about the insulation of houses in the UK, but maybe we will get there as well.
So have you sent off your paper to a journal yet, Daniela, your Washington consensus paper?
The Wall Street consensus paper, yes, I have, and I'm revising it. It's very close to, it's got a conditional acceptance. I just need to make it better. And you know, the process of making a paper better when you have free hand to make it better, it's very time consuming. So I'm now like, oh dear, let me do it. Can everybody hear this conversation?
Everyone can hear this conversation.
Oh, hello everybody welcome to my review process then. But yeah, I'm trying to make it a bit more intelligible for an audience that is not entirely familiar with the complexities of repos and market-based finance.
Yeah,
it's always a challenge, but hopefully, I don't know, you will tell me today, Josh. I'm looking forward to your comments. Hopefully it makes a bit more sense.
It makes sense to me, yeah.
No, well, to you, I don't know. I'm sure it made sense from the beginning, but yeah.
Okay, let me just say we are already having quite a few, over almost 40 people already in the room. So I think we can definitely start. I would like to use as much as possible the time. Let me say a couple of words about Daniela and then also remind everyone about how we are going to run the seminar as usual. So Daniela is in the program. She's professor of economics and microfinance at UWE Bristol. And she's been working over several years on shadow banking activities, and in particular, the relationship between shadow banking, monetary theory, central banking, and sovereign bond markets. And she has been, of course, also interested in the regulatory aspect of capital markets and stock markets. And tonight, she will be presenting, as you already heard, a very recent paper of hers that she hopefully will be published soon on the Wall Street consensus, the pandemic turn to green conditionality. And we are particularly pleased to have you here and to share with us your thoughts on this in such an important topic. As usual, we will be running the seminar for 40 minutes. The main presentation. Today, Josh Ryan Collins from IIPP will act as a discussant, so we'll offer 10 minutes or so comments, and then we will open the floor for discussion, and everyone who is in the audience will be invited to raise their hands or to submit a question, and I will be happily involving you in the panel. So you will be promoted in the webinar to the panel, and we can see your face and you can ask your question directly to Daniela. Without further ado, Daniela, thanks again. We are looking forward, and the floor is yours.
Good afternoon, everybody. And first, thank you to Antonio and to Josh and to the IIPP for the invite. I was told not to make rude jokes about economics, but I can make rude jokes about economists. Let's see if I can come up with one. I will start sharing my screen now. So yeah, I'm hoping people can see the slides. I want to talk about the Wall Street consensus in pandemic times. That is, the Wall Street consensus, I will show you in a second, is a term that I've coined to capture the way in which international development discourses and international development agencies from a wide variety of places and spaces have turned to a new development paradigm. I would like to think this is a new development paradigm. It's a new development paradigm that basically argues we have to create partnerships with private finance in order to have a sustainable financing model for the sustainable development goals. And I want to think through what has happened to this very new, it's quite a recent paradigm, probably most of it has been put in place, sort of the building blocks have been put in place after the global financial crisis. And I want to think what has happened to this new development paradigm since the global COVID-19 pandemic. And I will argue that we can see here the beginnings of a turn to green conditionality, and I will talk a little bit about what this green conditionality means. This is just to, as a brief parenthesis, this is work that I've done, and there is a paper coming out in the Canadian Journal of Development Studies, work that I've done with Yanis Dafermos from SOAS and Joe Michel from UWE Bristol, the same place I'm at. And I want to make 3 points this afternoon. That the Wall Street consensus comes with a reimagining of the state, a new architecture of governance that I like to describe as the de-risking state. And that is a particular way of thinking about how to organize economic processes and how to organize achieving the sustainable development goals through de-risking. If you want, it is a development as de-risking paradigm. Then I want to locate the rise of this new de-risking paradigm and the way in which it reimagines the state within a Minskian institutional supercycle story to tell you why we have this paradigm at this particular point in time. And I'm going to use this lens that we have from Hyman Minsky. The third point that I'm going to address then is how does the Wall Street consensus change with the global pandemic? And I want to talk a little bit about the idea that we are looking at a green conditionality or a green structural adjustment, as a couple of researchers have put it recently, that is coming to countries in the global south. And before I tell you about the Wall Street consensus, let me show you a video. I try to put it in my slides, but it's not possible. So hopefully I can show it to you now.
Okay, work with me here. Ending extreme poverty worldwide will take some $4 trillion a year. Development aid.
And yeah, we cannot see the video. You need to, as we agreed.
Another $1 trillion comes
Daniela?
from remittances, philanthropy, and some other sources.
Can you hear it?
We can hear it, but we cannot see it. You need to put down your PowerPoint so that we can see the screen behind.
I need to put
if you open the screen in the same page, would be brilliant.
Well, in my computer, it shows that I am. Okay,
but
let me.
Probably you have more than one screen, or.
Let me try this.
Excellent. Yes, we are.
So we're short about $3 trillion.
Okay, give me. I apologize. Let's try again.
Okay, work with me here. Extreme poverty worldwide will take some $4 trillion a year. Development aid is only $330 million. Another $1 trillion comes from remittances, philanthropy, and some other sources. So we're short, about $3 trillion a year short. Seems like a really big problem. Developing countries are a $12 trillion market opportunity. Opportunities in everything, actually. Hey, challenge, just found your opportunity. So besides investors, who would it help? These people, to live a healthy life. This man in getting a good income, or give this woman a chance to create something incredible. And everyone else in developing and developed countries alike. It's not just about getting private sector money into development. It's a process about when to use it, when to use public money, insurance, guarantees, or some combination that best fits. Not to replace development aid, but complement it. The World Bank Group and other development banks have the expertise to help private finance tap into developing markets, not just to invest in infrastructure projects, but in people. We call it maximizing finance for development. A little wonky, we know. And while developing countries are doing their part, it's just not going to be enough. That's why we need to rethink financing development, so this little one has a healthy life. And this woman can disrupt an industry with her product idea. And this youth, her big idea can change the world. In the end, we get strong markets and strong communities. And all of us get a world of opportunities. To learn more, check us out online.
Okay, so this is what I've shown you. And let me go back to my slides. What I've shown you here is a video produced by the World Bank Group to represent what they call maximizing finance for development, which is a new logic, a new financing strategy for the Sustainable Development Goals that puts global finance at the center of the center of development processes. It has various guises. It's also known as the billions to trillions agenda. There are various other initiatives like the G20 infrastructure as an asset class. And the key aim of this Wall Street consensus is to think through how do we escort the trillions of US dollars managed by institutional investors into asset classes that could support the sustainable development goals. And these asset classes are produced through public-private partnerships. That is, partnerships between the public sector and the private sector for the construction and delivery of public services. Why? The first question I think that we need to ask ourselves, I'm going to use my headphones now. So the first question that we need to ask ourselves is, how have institutional investors become new development partners? What does it mean to think about the trillions that institutional investors have as a source of financing for the Sustainable Development Goals? And they have a rapidly growing footprint in global finance. When we think about institutional investors, these include pension funds, insurance companies, sovereign wealth funds, high net worth individuals. And you see here in this graph that I've put, in this table that I put, the significant increases in the trillions of US dollars that they have under management. And their rapidly growing footprint is a consequence of political decisions that we have made in, let's call it, the countries of the global north. One that has to do with the weakening of the social contract between citizens and the state, the weakening of trade unions, which has shifted public provision of public goods towards asset-based welfare. In other words, citizens in the global north are no longer expecting for the state to provide pensions, for example, or to provide health, or to provide education. They are saving for future uncertainties through pension funds and through insurance companies. The rapidly growing footprint of institutional investors also reflects the weakening of the tax state, as Wolfgang Strick has put it, which is that the state is increasingly facing difficulties of a political nature, of course, to tax high net worth individuals or to tax multinational corporations. And this collective shift, or these collective processes and dynamics of weakening of the social contract and weakening of the tax state have given us a global financial system that is increasingly looking for profitable opportunities across the global south. Now, how is this growing footprint of institutional investors going to be captured in order to direct them towards the Sustainable Development Goals? And I think here it's important to try to distinguish conceptually between two types of states that we can think can be useful in order to think about for example, the transition to a low carbon economy. And I want to talk here very schematically about the distinction between a Green New Deal state and a Wall Street consensus de-risking state.
In the Green New Deal state, we have the state that is basically engaging in a massive public infrastructure investment. It provides green public infrastructure in various guises, but possibly through national development banks. Citizens have access to this green public infrastructure because there are no user fees, so they have direct access, and they will pay some taxes to the state. The state has the option to sell government bonds or to issue green bonds to global institutional investors, but these institutional investors are not directly involved or not directly part of the delivery and construction of public infrastructure. In the Wall Street consensus view, the de-risking state looks very different. The way in which the state organizes the construction and the access to infrastructure is very different. In the first place, infrastructure, and this is very broadly understood. We are not thinking here only about roads or about airports. We are thinking about water, waste, energy, education, health, housing, even nature becomes an asset class that is constructed through public-private partnerships. The state writes contracts with PPP providers. In these contracts, the state assumes responsibility for a series of risks. It basically de-risks this private provision by, for example, writing in those contracts that if demand for a highway which has a toll that has been constructed through a PPP, if demand for this highway falls because citizens are not willing to pay the highway tolls up to the level of the cash flows that have been viewed in or that have been predicted in the PPP contract, then the state assumes this demand risk and compensates the private provider. The state also assumes responsibility for political risks, that is the risks to private profits made by the PPP operator. If, for example, national minimum wages increase or climate regulations are put in place. So the state has a menu of risks that it is willing to accept through the PPP contract. The providers of PPP infrastructure will charge citizens a user fee in order to access these services. For example, a user fee to access a private hospital, a user fee to access water, a user fee to access private education or commodified education through PPPs. Very interesting here, I think, the state in these de-risking guides can contemplate the possibility of resorting to cash transfer or to the universal basic income. And I think here there is a conversation to be had about the ways in which the universal basic income can also become an instrument for de-risking in the Wall Street consensus in order to provide the citizens with some cash that they can access these user fees. Institutional investors become far more important in this paradigm, not only because they are expected to buy government bonds issued by the state, but also because they can become direct investors in infrastructure assets. For example, the French asset manager Meridiam has been building and is operating various hospitals in Europe and in Turkey. It's been building and operating various PPP renewable energy plants across Africa. And institutional investors can also buy SDG bonds that are issued by PPP companies with a very specific claim that such infrastructure asset classes can basically function in order to advance progress towards the Sustainable Development Goals. So what you can see here is a picture of a very different nature of the state, one that compensates the private sector for the provision of public goods and basically assumes a wide range of risks in order to protect the profitability, in order to protect the cash flows that global institutional investors expect if they are to invest in the SDGs. Now, where does this de-risking state come from? With Joe Michel and Yanis Dafermos, we've been thinking about and updating Hyman Minsky's work on institutional supercycles. And we argue in the paper that I just mentioned that the emergence of the Wall Street consensus can be understood as the outcome of complex political and macro-financial processes related to the evolution of capitalism in the global north. In order to think about institutional supercycles, we draw on the Minskian concept of thwarting mechanisms and supercycles, that is long-run institutional cycles where you have a distinctive macro-financial architecture where there are that is put in place in order to reduce the endogenous instability of capitalism. We argue that the institutional supercycle constitutes a third cycle in macroeconomics. It is of a longer duration than the classic business and financial cycles, and it affects how these cycles work. In the question and answer session, I can talk a lot more about this. Just to give you a sense of what we mean by these institutional supercycles, we argue in a paper that we've published recently with the Rebuilding Macroeconomics project that has financed this research. We argue that over the last 60 to 70 years, we can see two broad supercycles in the global north. One is industrial capitalism and the other one is financial globalization. And we identify 4 stages of an institutional supercycle. In the genesis stage of a supercycle, we have a lot of institutional innovation in order for the state to put in place new mechanisms through which it reduces the volatility of capitalism after a crisis and generates new space for profitability. These institutional supercycles are a useful way to think about political power as well and the distribution of political power. And what we argue that under the financial globalization supercycle that started more or less in the late 1970s, the beginning of the 1980s, political power has shifted away from industrial capitalism towards financial capitalists or financiers. And the ongoing debates around the Wall Street consensus have to do with the financial capitalists exercising this political power in order to create new mechanisms of stabilization, particularly from the state, so that profitability can be restored on a significant scale. How can we explain the Wall Street consensus through a supercycles lens? The Wall Street consensus, it seeks to create profitable opportunities for financial institutions from the global north, trying to address the problems of the low bond yield environment that we have in the genesis period that has been triggered by the global financial crisis. And what we have seen with the global pandemic is a turn to climate in the Wall Street consensus rhetoric. That means it is broadly agreed in global policy circles, including in financial capitalist circles, that the climate crisis is real and we cannot restore macro-financial stability without addressing it. And we think about the Wall Street consensus as a strategic intervention in the ideological battle over what form of capitalism should emerge in this new supercycle. Remember, we are in a period of genesis for a new supercycle after the global financial crisis, and the Wall Street consensus is a strategic response from private financial capital in order to fight against Green New Deal types of arrangements. Now, the COVID-19 outbreak, we argue, has seen a sort of supercharging of this Wall Street consensus. It has been used as an opportunity to accelerate the diffusion of the consensus. First, we have the pandemic-driven increase in fiscal deficits in the global south. It has reinforced the political appeal of recoveries driven by PPP-financed infrastructure. And this is very much the case because PPPs are arrangements in which the state doesn't spend directly. The risk that the state assumes that I showed you earlier, they are recorded as contingent liabilities. They are off balance sheet and they allow large infrastructure projects to be put in place that do not show up in public debt to GDP ratios. So they are a very attractive sort of arrangement for governments in the global south who believe that the limits to fiscal expansion, particularly after the COVID-19 crisis, mean that we need new arrangements of financing infrastructure. The second point, or the second reason why the Wall Street Consensus has become even more powerful with the global COVID pandemic, we have seen the normalization of central bank interventions to de-risk the bonds held by institutional investors. As I've said earlier, the de-risking state is important not only through the fiscal resources that it directs towards PPP infrastructure that are written in the legal contracts, but the central bank has an important role there as well. And since the COVID-19 pandemic, what we have seen is central banks across a large number of emerging countries intervening in government bond markets in order to de-risk them. In other words, to stop their prices falling and their yields rising, and thus protect institutional investors. What we will see is that this logic of central bank intervening in bond markets will be expanded further and further in order to protect institutional investors that want to invest in other types of infrastructure asset classes. Thirdly, the pandemic has created a momentum for the support of policy initiatives that promise infrastructure-led green recoveries and climate resilience. This is now the discourse that you see across a wide range of global development initiatives focused on green recoveries and on climate resilience. Now, what does this have to do with green conditionality? We argue in the paper that since the global COVID-19 pandemic, we have seen the emergence of green conditionality, and we give several examples of what this green conditionality will mean in practice for countries in the global south. Just to give you a sense of the political urgency and the political appeal of these narratives, here is a recent report from the Global Investors Alliance for Sustainable Development. The report is called Renewed, Recharged, and Reinforced. And one of the points that they make in this recent report is that the scale of the challenge created by the COVID-19 pandemic calls for reinvigorating public-private partnerships to a degree not experienced since the World War II, and a degree that has perhaps never been seen in peacetime. In other words, there is a call for a Marshall Plan for poor countries or for the global south, but a Marshall Plan that is framed as a massive upscale of public-private partnerships and a massive upscale of the de-risking state. And if countries in the global south won't do it on their own, then we will use the institutions of global development in order to enforce these partnerships for de-risking. And we have several examples in the paper of what kind of instruments of de-risking the Wall Street Consensus has in mind when it talks about the turn to green conditionality. And we look there at climate PPP infrastructure as an asset class. We look at climate rescue of last resort, the disclosure of climate-related financial risks, and very important, carbon pricing. Let me start with the climate PPP infrastructure as an asset class. The idea is that this is a very useful instrument to power green recoveries in the context of growing public deficits in the global south. There are several examples of where this PPP infrastructure as an asset class has been promoted. One that we look at in the paper is the Next Generation Africa Climate Business Plan. And the idea is that the state has to assume even more risks that are embedded in PPP contracts, particularly the risks of natural disasters or unforeseen shocks, such as the COVID-19 pandemic. In other words, the state needs to protect private finance and PPP providers that are financed from these global institutional investor portfolios. They need to be protected against black swan events like the COVID-19 pandemic. There are also potentially new forms of subsidies that are being contemplated in this new development agenda. We look at the green supporting factor for green asset classes. That is the idea that green asset classes, and here what is a green asset class becomes a subject of intense political negotiation and political struggle, because private financial institutions have for the last 10 years come up with a private taxonomy of what is green and what is dirty finance. And this private taxonomy is generally known as environmental, social, and governance scoring. That is a set of criteria that identify the behavior of a corporation, for example, or the behavior of a government on environmental issues, on social issues, and on governance issues. These criteria are aggregated into a rating. And if there is a very high ESG rating, for example, for Tesla, then that means that loans made to Tesla or bonds issued by Tesla will be treated as green, and they will be and the central banks will support financial institutions that lend to Tesla or lend to high ESG rating assets. They will support them, for example, through preferential regulatory regimes. Now, we argue in the paper and that, of course, when you allow private finance to write the rules of what is green and what is dirty, that opens up the space for a lot of greenwashing. And we know that a lot of greenwashing is already occurring in that space. But that is not necessarily a problem for private finance, because the central bank is expected to assume the cost of greenwashing or the risks of greenwashing for private portfolios. And this goes to a new institutional innovation that we have seen and we expect to see being scaled up quite significantly over the next 5 to 10 years, that has to do with the central banks becoming climate rescuers of last resort. What does this mean in practice? Since 2008, we have seen first in high-income countries, central banks intervening in asset markets or in bond markets in order to protect financial investors from several liquidity risks or from, including from insolvency risk. We argue that this market maker of last resort that we have seen becoming normalized in high-income countries will be extended so that central banks take over climate-related financial losses. In other words, a central bank that is a climate rescuer of last resort will become a residual purchaser of devalued assets that are linked to climate-impaired infrastructure. So, for example, if there are bonds if institutional investors hold bonds issued by Kenya, for example, or by a Kenyan PPP in order to construct and manage a highway that requires tolls in order to be used, then the Central Bank of Kenya will end up buying and protecting the value of those bonds if you have a climate disaster that affects that particular highway. So what we see with this climate rescue of last resort is central banks across a broad range of middle income and low income countries being asked to de-risk greenwashed assets that have been previously identified as green through these private ESG taxonomies. But because there is greenwashing there, of course, when a climate event hits, instead of becoming stranded, they are eventually taken over on the balance sheet of the central bank and on the balance sheet of the state. Another very important instrument that we think matters in this story of green conditionality is the turn to the disclosure of climate-related financial risks. And that comes from work done by the network by central banks in the network for greening the financial system. This is a very large network and is growing every day, and it has been welcomed. The work of the central banks has been welcomed because it recognizes the importance of climate risks as financial stability risks. In other words, central banks have acknowledged publicly that they need to do something about the climate crisis because a climate event might become a financial stability risk, and central banks have a mandate to protect the economy from financial stability risks. However, once this public recognition is in place and once central banks accept that they will have to take care of climate risks one way or another, the political struggle of what central banks should do has sort of morphed into an emphasis on disclosure. And the idea is that central banks will require or mandate financial institutions to disclose the way in which climate change might affect their portfolios, but central banks do not see private finance as a key driver of the climate crisis. If they saw private finance as a key driver of the climate crisis, we would have policies that regulate dirty finance. We would have regulatory regimes that penalize financial institutions that hold dirty assets, for example, by higher capital requirements or by central banks not including dirty bonds in their emergency purchase programs. However, the political struggle in the Wall Street consensus is to focus central banks on this disclosure lens and not ask them to go any further than this idea of simply creating more information for the public as to how exposed financial institutions are to climate change. Finally, carbon pricing, I think, is probably one of the most important policy solutions to that is being discussed in Wall Street consensus circles. And the idea is that with an adequate carbon price, much higher than what we have at the moment, we would provide a clear financial signal to investors about the viability of low carbon investments. And therefore, this would also work to promote climate PPPs, because financing for these climate PPPs will become cheaper. In the aftermath of the COVID-19 crisis, we expect carbon pricing to be used as a means of reducing public debt and as a means of rebuilding fiscal space, even if that means political backlash like we had in France with Macron trying to increase the cost of fossil fuels for regular citizens. So we look at these four different mechanisms for creating or for advancing the Wall Street consensus and for advancing de-risking. Again, to remind ourselves, they have to do with pushing or creating political momentum in countries in the global south, and where there is no political momentum, using World Bank or IMF conditionality in order to push countries further into supporting climate PPP infrastructure as an asset class, into supporting governments to sign PPP contracts where they assume larger and larger shares of the risks that are embedded in such provision of public goods. We see a rapid push towards making central banks in the global south accept their role as climate rescuer of last resort, which is basically a way of de-risking portfolios of PPP infrastructure assets for institutional investors. Instead of asking central banks to regulate and penalize dirty finance, we have a very unambitious step of using the disclosure lens in order to make information about the climate exposures of financial institutions more widely available. And we have carbon pricing as a mechanism that ensures a change in the price signals that the market provides to financial investors in order to ensure a faster transition towards low carbon economy. Now, we argue that, and I want to finish with this, that the Wall Street consensus undermines climate-aligned development. It relies to a significant extent on shadow banking practices. I didn't want to spend a lot of time here discussing that, but all the de-risking, a lot of the de-risking strategies that Wall Street consensus institutions have in mind involve structural changes in the financial system in order to enable global institutional investors to enter and exit development asset classes faster than they can now. It makes the the Wall Street consensus makes the global south much more susceptible to the global financial cycle. The global financial cycle, which is an idea, a concept pioneered by Helen Ray, basically captures the way in which the financial markets of countries across the world have become much more interlinked, and they move much closer according to the rhythms of the US dollar financing conditions. And the Wall Street Consensus is basically a project of integrating, of creating more market-based finance in the Global South in order to accommodate the investment practices of institutional investors. And it's a project of ensuring that central banks across the Global South do not use capital controls in order to manage the significant volatility that the global financial cycle creates for these countries. We also know that the climate infrastructure gap is unlikely to be filled in through the Wall Street consensus policies because it requires such a significant scale of de-risking instruments from the state. And I've been reading recently that the French Senate, in describing the effect of PPPs for the French state, and PPPs have been a form or have been used by high-income countries for a very long time in order to create and deliver public services. The French Senate has described these PPPs as budgetary bombs in the sense that they create contingent liabilities for the state that will explode at some point, because we basically don't know. I can talk to you about many PPP projects in the Global South. We basically do not know the scale of budgetary commitments that the state assumes by taking all the risks in a PPP contract. And finally, and very important, the Wall Street Consensus does not address the climate justice issues. It seeks to resolve the growing climate inequalities simply by promising to make climate infrastructure in the Global South more attractive to global institutional investors. That comes with user fees for private citizens. That comes with the removal of subsidies to fossil fuels in the Global South, on which many citizens rely. And it comes with green conditionality that basically restrains countries in the Global South from putting in place Green New Deal types of initiatives where a much larger state assumes the responsibility of coordinating and, in a sense, centrally planning a transition to a low carbon economy. I'll stop here. Thank you.
Thanks, Daniela. This was great. I think there is so much food for thought there, and it's fascinating to see how these things are linking up in a quite complex but at the same time worrying way. So Josh will have up to 10 minutes for discussion to introduce a number of teams, and then we will start open for the broader audience. Josh, please.
Thanks, Daniela. That was great, and I'm a big fan of this Wall Street Consensus thesis. So my questions are not too difficult. You'll be disappointed to hear. But I suppose it would be good just to play a bit of a devil's advocate, just to kick things off. You've described what sounds like a sort of fairly kind of Leviathan-like sort of direction of travel here, for whether it's, you know, the IMF, the World Bank, all of these multinational development banks, and governments in both advanced economies and the Global South, essentially coordinating to deliver this kind of new approach to financing the SDGs and the climate as well, and these other aspects of development. Now I'm sure I'm sort of, you know, exaggerating the approach you've taken there, but it would be good just to hear a little bit about, you know, where are the nuances, where are the sort of complexities there. So just to give one example, I guess, as you know, the IMF has pushed back quite, or dropped essentially its opposition to capital controls, and has come out and essentially said, you know, actually capital controls are quite a sensible policy for emerging developing countries at a certain stage in their development cycle, and we need to give them more time to develop infant industries, etc. So I wondered, you know, that's just one example of how maybe things might be a bit more complicated. I suppose also that the other sort of question might be just on the COVID crisis. we've certainly seen central banks and ministries of finance in advanced economies coordinating in a way that we didn't see in the financial crisis of 2007, 2008. So we've seen a much more explicit, I would say, role for the central bank in essentially financing fiscal expansion than we saw in 2007, 2008. Now, you're much more of an expert than me, I'm sure, on whether there's been anything like that in developing countries, in emerging markets. But I suppose what one might say, was to take a very broad view, one could argue that COVID has led, in fact, to a slightly different kind of coordination of finance with government, in the sense of actually supporting fiscal expansion. You know, obviously we've got in Britain, we've got the Conservative government launching an infrastructure bank. Admittedly, we don't know exactly how that will be financed, but things almost seem to be moving away in advanced economies from the direction you've described in the global south. I suppose the other point just on that is, I think the PPPs, again, in advanced economies, as you're sort of alluding to, have been completely discredited as sort of sensible ways of organizing industry. So it would also be good to hear how developing countries have somehow been convinced that, in fact, they're these fantastic instruments to go forward. I'll start with that.
Okay, can you still see my screen? I want to show you.
Yeah, we can still see the screen. Yeah.
Can you see what I'm showing now, Meridian? No,
we can't see.
You're seeing my slide. So
yeah.
Let me stop sharing. Let's see. Okay, so Josh, you have raised 3 points, I guess, here. Okay, so let's see, I can share this. So Josh, you have raised 3 points. The first one is the Wall Street consensus a slightly conspiratorial sort of idea that doesn't reflect the sort of nuances of what has been happening over the last 10 years in the global south, including the fact that the students of development processes have been surprised to see that the IMF has dropped opposition to capital controls. With its drop in opposition to capital control seems to go against the idea that the IMF and other international financial institutions are doing everything possible to encourage countries in the global south to welcome investors with open arms. And open arms means you don't close your arms with capital controls whenever you want to. So that's one question, right? The Leviathan direction. I would say certainly there is a growing recognition particularly from the IMF, and we use the IMF as an example because the IMF has been such a staunch opponent of capital controls for a very long time, despite the obvious empirical counterfactuals over and over again. And I would say that there is a very significant distance between the discourse and the practice, and that significant discourse sort of lends itself to the idea that the Wall Street consensus is a very powerful political narrative. And let me give you the example of the DSSI, the Debt Service Suspension Initiative that has been introduced with the global COVID pandemic. And the idea of the DSSI was that we have lots of countries in the global south that are at high risk of debt distress, basically because their exports have been collapsing. They are very reliant on imports anyways. Capital flows have been collapsing, particularly from institutional investors. And what they need is a breathing space, right? And the DSSI would give them a breathing space by suspending the interest payments to at least on bilateral loans from high-income countries, but also on bonds held by private bondholders, et cetera, et cetera. And what we know from the DSSI is that we have had around 40 countries that joined the DSSI, but there are another 40 countries, Ghana and Kenya are good examples, that did not join the initiative, although it would have provided them with fiscal breathing space, because they worry about market access. And the narrative of market access, which says basically, I don't want to scare investors away by resorting to mechanisms that will basically that ask them to share some of the pain, right? Which capital controls is even a bigger way of asking investors to share some of the pain. This market access narrative has been very powerful because, and it has convinced and persuaded countries in the global south that capital controls are never even good as a last resort measure. So I don't see many countries in the global south actually having resorted to capital controls, even if we know that immediately in March 2020, immediately as the global pandemic hit, there were many good reasons to put capital controls in place. So I am not convinced that capital controls have become normalized as a policy option for these countries. Quite the opposite. The narrative of market access is far more powerful, and then this narrative of market access is a narrative that comes from the logic of the Wall Street consensus. And I invite the listeners to go to the IIF, to the Institute of International Finance webpage. This is a lobby group for private finance, and the IIF makes it very clear that if countries in the global south are expecting institutional investors to help with climate infrastructure investment, then they have to bear in mind that they cannot put any restrictions on their entry and exit from these countries. So I would say this is not the nuance that is complicating in a sense this Leviathan direction. Of course, I would accept that there are varieties of de-risking states, and for example, if you read the paper on the Wall Street consensus that I'm about to publish, we see there Vietnam is a very interesting case study, because Vietnam has been used by the World Bank as one of the pioneers of the maximizing finance for development. The World Bank has published an infrastructure sectoral assessment program, which basically says, how can we help Vietnam push PPPs in infrastructure as fast as possible in order to get institutional investors in? So you have this part of Vietnam assuming the role of the de-risking state that goes hand in hand with a Vietnamese developmental state that does a lot of the sort of traditional developmental work and does a lot of de-risking for private and public state-owned companies in Vietnam. There is not a lot of space to talk about these varieties of de-risking here, and I accept that there is nuance, but in general, this requires an institutional capacity at the level of states in the global south that I worry is getting significantly eroded by the push for the de-risking state that we see. The second point, you discussed the idea of coordination between the central bank and the state, right? And what we have seen in the countries in the global north is indeed, and in many ways for us quite surprising, because what we see is central banks basically saying to governments, spend as much as you like, and we will be there in order to protect your borrowing costs, right? And this is not only about countries in the global north, but it's also about countries in the global south. There are many examples of countries like Indonesia, for example, where the Indonesian central bank has gone and bought government bonds in secondary markets in order to protect their price, or in order to keep yields low. But in the Wall Street consensus narrative, this makes a lot of sense. This doesn't go against it. It is consistent with the Wall Street consensus narrative that says institutional investors need protection from daily volatility in the price of these government bonds. We are here to protect you, right? So it is quite paradoxical that what we see as helping the state can work also to help private finance. And that is the very powerful political appeal of this Wall Street consensus narrative, that it somehow lends itself to different political narratives. But also we have to bear in mind that the form of coordination that we have here in the global north between the central bank and ministries of finance or treasuries is entirely on the terms of the central bank. This is not the state sort of deciding that I'm going to organize my economy or I'm going to organize my infrastructure spending in this way, and I need the central bank to basically support me by keeping my borrowing costs low. No, this is not the state in charge or driving the terms of the new coordination regime. I would argue it is the central bank, and there is a whole other kind of worms to be opened and discussed on whether this is the kind of coordination that we need in order to get a low carbon transition. And what we argue in the paper actually is that in general, we could see the fact that central banks are far more reluctant to do a lot more on the climate front should be seen, except for de-risking greenwashed assets. The fact that we see central banks being far more reluctant is a signaling of the fact that the political arrangements that we have from the Washington consensus and from the financial globalization cycle are there to stay. And that political arrangement is an independent central bank that may do some support for the borrowing conditions of the state, but on its own terms, and in the countries in the global south with an eye to protecting institutional investors. Thirdly, you said, how do we make sense? And I think this is one of the sort of interesting research questions that can be addressed in the future, trying to make sense of what are the political coalitions that are necessary in countries in the global south for the de-risking state to actually materialize, right? This is not simply a development paradigm that gets implanted into a country regardless of the political structures that are there. It does require a lot of political work for that to happen. It requires political coalitions to put it in place. And I would argue that two things. First, that the role of PPPs in high-income countries is not as insignificant as we think. In other words, the idea that PPPs are no longer an important way of organizing public service delivery is a bit moot. And I'm showing you here the Meridiam, which is a French asset manager that does PPPs. This is its mode of operation. It does PPPs in a series of energy transition projects, mobility, and social projects. And by social, they mean constructing hospitals. And here you have the range of countries that Meridiam is active in. And you can see how many projects they have in the US. You can see how many projects they have in Europe. PPPs are not dead. Actually, they're quite alive. We just don't look at them anymore because PPPs at the end are a boring story. Everybody knows they're a bad idea. They somehow happen. Nobody understands why they don't stop happening in terms of the political willingness to support them. So they do happen. They are quite significant in high-income countries. They are growing in scale. The question is, how do we make sure that they happen in countries in the global south? And here, the institutions of the Wall Street Consensus, which go from the World Bank to the African Development Bank to the IIPP in Latin America, almost every multilateral development bank I can think of is working towards pushing the countries in the global south to sign more PPP contracts, to assume more de-risking in those PPP contracts, with the idea that, perfect is the enemy of good. Perfect would mean public investment, but we don't have public resources. Good is PPPs, and don't worry, they will not be that expensive in the end. We don't know whether they will be expensive or not, because I have seen very few PPP contracts that are transparent in the way that they calculate contingent liabilities. That is, how much is the state actually getting exposed by assuming a part of the risks in these contracts. We don't know that. And until we do know, I expect that these are quite significant. I didn't talk very much, but this is not only about sort of assuming demand risk in infrastructure that is commodified, but often the central bank or the National Development Bank in a series of countries in the global south are asked to assume currency risk. Basically, you provide protection against currency volatility to the private PPP investor. And this Meridiam asset manager, if you start reading through their documents, you will see this written sort of black on white. We want de-risking. We think de-risking is the next is development, and we expect the state to do a lot of it.
Okay.
Thanks, Daniela. I think we have quite a few people already who are raising their ranks. Josh, if you don't mind, you want to have a quick reaction, and then
I'll just have one quick one. Yeah, it's just I just wondered if there's any alternative sort of paradigms going on here. So China, for example, has been investing a lot into Africa, into African infrastructure. are they adopting similar type of model, or is it quite a different sort of approach, possibly also exploitative, but are the dynamics a little bit different, and does that offer an alternative sort of path?
Daniela, if you don't mind, let's pick up 2-3 questions.
Okay.
I have one as well later, but I'll try to start promoting. Well, the first one is Yorgos Galanis, who was the first one to have a question, and then Peter as well, Andreas Nielsen, who is going to be joining. Yorgos, please raise your question.
Hi, thanks. Thank you very much, Daniela. This is very interesting. So I had in mind, so you present a theory of supercycles. The supercycles have in common the fact that they have thwarting mechanisms which create the cyclical behavior on one hand. On the other, my understanding is that the different cycles have different specific characteristics of this thwarting, if you want, mechanisms. Now, what you present as a solution, this green solution, is related to the downturn of the current cycle. Okay, so I understand that if we had this, thinking like some years back, then we wouldn't have this crash. We wouldn't have this nadir, if you want, of the cycle. However, if we take into account the fact that each cycle has new characteristics, then this policy is related, if you want, to the next cycle. So then the question is, how do we know that the next cycle where this policy is addressed to will have similar characteristics, because we're now just at the upturn of the new cycle, if this makes sense. Thank you.
Thanks so much, Georgos. Good to see you. Peter, would you like to raise your 2 questions, and then Daniela, you have a chance to go for this first round of actually 4 questions at the end.
Yes, please. And thank you. I think actually a few of the points were addressed during the very thorough walkthrough of Ryan's questions also. But the first thing I wanted to ask, this is the current pandemic and the crisis that followed is a good test of one of the original, say, theses that were presented in your work on the new Wall Street consensus, on the private turn in development finance, etc., that it would increase fragility because it would be more susceptible to the whims of private finance, etc. So I happen to work in development finance as well professionally, and I have observed, as you mentioned, moratoria, the DSSI, etc., that development financiers, traditional publicly owned funds, have been quite concessional. There are moratoria of various kinds, etc. But I'm wondering if, to the extent that you've been following it, you can say anything about, say, how more blended finance mechanisms, private sector windows, where we would be working more closely with the private actors as well, how they have been affected, because I imagine that these would be more susceptible to these private whims, private concerns about risk, etc. Then secondly, and this you also broached when you addressed the issue of central banks, in particular in developing countries, but concerning, say, the political economy of the Wall Street consensus or the private turn in finance, how has the reaction been in developing countries? What kind of communiques have you been seeing where these have reacted to new instances of conditionality, etc.? I know that for the Addis Ababa action agenda in 2015, there was a lot of opposition, but I'm wondering, is there any opposition still?
Thanks, Peter. Daniela, you have 4 quite substantial pieces of questions. So
well,
please.
thank you. Georgos, I'm going to start with your question because it's quite a difficult one, and we've been debating this with my co-authors, Joe Michel and Yanis Dafermos, in the sense that it's quite difficult to predict what is the new configuration of thwarting mechanisms that would lead to a new super cycle. So you're right, in the sense that each super cycle has its own set of thwarting mechanisms. These thwarting mechanisms are not per se generating the cyclicality. The cyclicality is there endogenously, right, from from the way that capitalism is organized. The thwarting mechanisms, what they do is they are put in place in the Genesis period in order to reduce the volatility or the cyclicality of the smaller business cycles or the shorter business cycles. But we argue in our work that thwarting mechanisms at the beginning are effective, right? I mean, in the sense, central bank independence, monetarism, fiscal restraint was an effective way of introducing macro financial stability after the crisis in industrial capitalism supercycle. But the effectiveness of these mechanisms gets eroded over time because you have private finance and you have capitalism, and they work in order to erode the sort of the repressive mechanisms that the states put in place in order to reduce excessive behavior. So what we have seen, you're right, with the crisis in the financial globalization supercycle, we have seen the erosion of a series of thwarting mechanisms that were supposed to keep particularly private finance in check. We have seen the growth of shadow banking. We have seen central banks accommodating this volatility of the particular financial instability that comes with shadow banking from, for example, through the market maker of last resort role of the central banks. What we don't know for sure yet is what will be the configuration of thwarting mechanisms that we are looking at in the new supercycle, because the logic of the of a new supercycle is that somehow these thwarting mechanisms, and we presented several there, right, from PPP infrastructure asset classes to carbon pricing to central banks as climate rescuers of last resort, they are supposed to somehow restore macro financial stability. And it's not very clear to the three of us, to me, Yanis, and Joe, that these thwarting mechanisms will be effective. I have my doubts because, in a sense, I don't think that these are that they will be long-term effective, or not long-term, effective over the next 5 to 10 years in order to generate sufficient, I would say, profitability. I'm now a bit skeptical about saying generating growth because I'm starting to read the degrowth literature, and I don't know if I want to sort of normalize the growth as a desirable outcome. But so we have our doubts about the extent to which we are going to see a green super cycle. This is what we are looking at here, the idea that you can have a green super cycle somehow, but it's a green super cycle that preserves the political architecture of the financial super cycle, right? Which, or the financial globalization super cycle, where basically private finance is in charge and the state de-risks its adventures in the global south or in the global north, wherever. I'm not very clear on that, and I guess we can be clear because it's very difficult to be very predictive with this framework, in the sense that there are political struggles that we cannot capture directly through this framework. And there are unexpected consequences that we cannot capture. But what we see for sure, for certain, is a very clear strategy from private finance in a series of related policy domains that are pushing towards establishing a green super cycle. Whether this will be the case or not, I don't know. I would be very happy to have further conversations on this, but at least we know that this is where the political logic is going, whether it is a political logic that is resilient to the kind of climate events that we will have and to the kind of politics that we have that is increasingly authoritarian in many spaces is another question. Then to Josh, just to respond, I think, and maybe I can connect this to the question from Peter, if I may address you, Peter, with your first name. The idea of China is a complicated actor in this story, in the sense that for a while there was a logic of a Beijing consensus. I've seen several countries in Asia in particular discussing the Beijing consensus as an alternative development paradigm that basically says, well, look at what China has done to be successful. China has basically had a developmental state as we know it from the old developmental state literature. The developmental state has organized particularly industrial production in a way, and supported industrial actors in a way that is quite sort of that is basically industrial policy. It has had significant capital controls to make sure that it protects these industrial actors and the financial system that is supporting them. They need protection from the volatilities of the global financial cycle. However, what China does at home is not what China does overseas. To my knowledge, and here I'm not a China scholar, maybe Antonio can help us there. I'm not a China scholar, but my understanding from talking to or listening to policy debates in the Global South is that there is a certain uneasiness about the Chinese presence in the Global South for a variety of other reasons that have to do with the way in which the political economy pressures that come from there. So in a sense, countries are caught between the promise of infrastructure from Beijing or the promise of infrastructure from the Wall Street consensus. And none of the two are particularly appealing. I think the most important part for me is that none of the two create autonomous developmental space or allow for an alternate autonomous developmental model that basically insists on building institutional capacity for the state. And I'm not romanticizing here development or the achievement of the Sustainable Development Goals or industrial policy, even if it's a green industrial policy. I'm not romanticizing it. As a progressive scholar, I'm aware that it requires technocrats that are prepared, that it requires political willingness. But certainly, if you channel a lot of the energy of the state into creating de-risking infrastructures, then it's very difficult to have the kind of bureaucracy and institutional capacity that we would want to have if Green New Deal type of arrangements would sort of take place or materialize in the Global South. So I mean, China is important, but I don't think it makes a significant difference in terms of autonomous policy strategies. Okay. And finally, on the question of first, the question of blended finance, I think is important because blended finance is this idea that you blend concessional resources with private finance in order to make infrastructure projects more attractive. And what we have seen with the rise of the Wall Street consensus as a development paradigm is that the redirection of concessional finance towards de-risking. So for example, the World Bank or the African Development Bank takes the high risk tranche of a particular PPP project. There are many examples in Africa for that. So concessional resources from multilateral development banks are used in order to push for more de-risking and to create the pillars of the de-risking state. Whether there is political opposition to that in countries in the Global South, I think it's an interesting question to which, again, I don't have a full answer, because I think it's, in a sense, one has to piece together different parts of the puzzle in order to understand or to create a strategic political platform of opposing these developments. There have certainly been a lot of opposition to individual PPP projects. And my Senegalese colleague and friend, Dongo Silla, has been looking at, for example, the way in which PPP projects in Senegal have been resisted by civil society organizations, the same in Tunisia, because they clearly increase the burden on particularly the poorest of citizens, simply because they impose user fees, they reduce direct subsidies from the state. So there is political opposition to PPPs as a project of commodifying public infrastructure, including commodifying health, commodifying education, et cetera, but there is no, I haven't seen a sort of broad coalition that says, wait, this is not just about PPPs and user fees, or this is not just about commodification of public infrastructure, but this is about a new mode of governance that requires the state to basically redirect resources from whatever development agenda it might have towards de-risking private investments. So that I have not seen, but I'm very happy if there are examples. I mean, civil society organizations are doing their best, and I think that's where most of the opposition has been concentrating. However, that requires the political strategies within civil society organizations require also creating a sort of political momentum for a lot of issues that are very removed from the everyday experience of regular citizens, right? Because you have to understand the turn to market-based finance to look at why there is a project of changing financial market structure in these countries. What does it mean that central bank de-risk bond finance? These are not terms that or political issues of immediate salience for a regular citizen. And I think it's our challenges as development economists, as progressive, I think of myself as an academic activist of some sorts. It is our challenge to translate these very technical developments into or to uncover their deeply political nature.
Thanks, Daniela. I mean, there is lots to build on what you've just said. I mean, I refrain from commenting on the, nuanced ways in which, what you are discussing links to industrial policy, because of course, lots of the PP kind of arrangements in the past have not led, not just in terms of de-risking, creating position of rents, but have not led to any investment in the same, let's say, energy infrastructure. I'm thinking about the gas industry, for example, in many African countries, which could have actually supported many of these countries in their structural transformation effort. So there is a problem around also, how you channel the right type of finance, but how this finance is then used or not in tandem with industrial policy. I will stop because I want really to give a chance to, we have 3 people lined up, Diana and Kirsty and Miriam, who have raised their hands a few minutes ago. May I invite Diana Donovan to just unmute herself and raise her question, please? Okay. Oh, here we are. Please go ahead.
Yes. Sorry. I think I've raised my hand by mistake.
Oh, okay. Okay, that's fine. That's fine. Miriam and Kirsty, they also introduced the question on. Here we are, Kirsty. Yeah.
Hey, yeah, I can go next. It sort of builds on, Daniela, what you were just talking about with regards to kind of communicating this to normal people. I went to the Mark Carney's Green Horizon conference a couple of weeks ago as an academic, but a journalism academic, looking at environmental impacts. And this was exactly the sort of conversation that they were having around disclosure and things like that. So interesting stuff. I was actually just wondering, what you think that journalists can do to sort of make this not a boring story, as you called it. I don't think most people know about PPP, and I don't know whether it's too complex to, for most people to be bothered to get their heads around, and what they could do if they actually understood that information. And obviously there's campaign groups all over the world, but I'd be interested to know if you have any thoughts about that. And also, I think the final part of my question was, I've forgotten what the final part of my question was. So I'll just leave it there.
Great, thanks, Kirsty. Miriam, would you like to join us?
Yes, thank you. Yeah, I have 2 questions. My very, 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 very simple question is will central banks really be able to save financial markets and whatever because of the kind of the allowance of capital flows to come in and out, and the size of and interconnectedness of the financial markets with the bank market and etc. Sometimes it seems, especially with the debt, if you see that they only want to have, the financial sector only wants to have a case-by-case approach, which looks like for next year pretty difficult. That's one of my questions. And my second one is then within the context of what you're saying of kind of a green super cycle, do you think therefore we should absolutely not support the taxonomy? And as you know, we are now, and if anybody of you want to sign on, we want to really push for a very brown taxonomy to be mandatory and to divest. But how do you see then this taxonomy issue within the context of what you've just been saying?
May I just add, sorry, I've just asked Antonio if I could just tag on the final bit, Daniela. So I was at a conference of African women climate journalists last week, and they have you know, incredible challenges, you know, harassment in the workplace and outside of it, sort of not being really valued as professional journalists, access to data, access to, you know, powerful people and things like that. So I guess one thing to consider perhaps as you said, as an activist academic, is how you make sure that you get the right information into the hands of the people in those countries that you're talking about, in order that they can, you know, work out how to communicate these things to their publics.
Right, a great set of questions. Daniela, yes.
Thank you. Kirsty, you ask very difficult questions to which I don't know that I have the answers, because here I am trying to demystify PPPs, and I don't know that it's an easy job. I mean, in general, there is I think a political difficulty in many countries, including the one I live in, which is the UK, and the one I was born in, which is Romania, in the sense that public infrastructure like health, for example, has been eroded and dilapidated by years of neoliberalism one way or another. And there is a very strong political appeal for the everyday citizen to have good services, particularly for health and education. And they think, okay, if the private sector is much better at doing it than the state, then so be it. Why am I going to fight for public services that are of very poor quality? And that I know even on my own, from my own experience of getting my mother through heart surgery in Romania, that the appeal of the private sector is very significant. And if you're middle class like I am, and you have the resources, you think, okay, I'm going to go to the private sector because I know that this is where I'm going to find the quality service that that the public sector cannot provide. And I think there are two ways to sort of respond to that. One is that a lot of this private infrastructure provision of public goods has the state behind it. I mean, we don't see it, but there are significant public resources that are being directed into making sure that the private sector can provide these public goods. Otherwise, it doesn't really work, or it doesn't sort of generate the kind of profitability that the private sector expects from this project, so they wouldn't be there. So one, we know that there is a lot of our own sort of state collective resources going into the private sector. Where the political struggle is more difficult, I think, is trying to create a narrative that says you have to trust the state again, because this is what we're asking. We are asking citizens with a sort of get the private sector out of the social infrastructure story, or get the private sector out of your highways, or get the private sector out of your renewable energy sector, is to say you have to trust the state. And there is a challenge of also pushing for state institutions in general to become more effective in organizing and delivering public services. So there are many battlefronts that we have. My sense is that this is a fight that we need to fight, because there is sort of no alternative. The alternative is that we're moving more and more towards private provision of public goods, and that we know excludes lots of people, it excludes lots of issues. My friends in Kenya tell me that, for example, questions that have to do with gender and maternal health care, for example, or completely fall off the sort of list of priorities of the private sector, and that leaves women at great danger of maternal health. So I guess the challenge is to make PPPs not just on their own as a sort of problem of the private sector, because that's not the political narrative that you can sell, to just oppose the private sector. I don't think that's strategically useful. I think more interesting is to think of what are the risks, or how is the state basically subsidizing the private sector in order to give us this sort of narrow set of services that are also expensive. And maybe that would be a better campaign. How we create links with civil society organizations across both high-income countries and poor countries, because you see, even here, we think that PPPs are an old story that doesn't convince anybody anymore, when in practice they are a pretty important story that continues to gain scale, as you can check from the Meridian sort of investments. I'm happy if you have suggestions of how to make this. I think that maybe academics are not the people to ask how to persuade the sort of big chunks of population that these issues are relevant. But we are certain, I think we are here to help one way or another to provide some insights, and then maybe somebody else does the difficult job of translating them. As for Miriam's questions, I think they are very important because you point there to something that is very fundamental, which is what are the limits of the de-risking state, right? I mean, can we imagine a beautiful universe in which somehow the state is able to make life beautiful for private finance sort of endlessly? And I think the most simple and a bit sort of naive answer would be that, well, you know, if the climate crisis is as real as many of us think it is, then, well, we'll all die in a greenwashed financial system, which is not a nice alternative. But I think there are more sort of practical limits to the de-risking state, in the sense that the de-risking state in the global south can use the central bank to de-risk local currency investments of institutional investors, but they will leave. They are not going to stay there and continue to provide finance, because basically we will see more and more, as more and more resources are going into de-risking, there will be sort of narrower and narrower space for basically servicing these de-risking requirements. So I think this French senator's idea of PPPs as a sort of budgetary time bomb is quite a powerful one, because it says when it explodes, then in its aftermath, the de-risking state will just make sure that institutional investors can leave, and that's about it. And then everybody else is left with a mess, and with the sort of the sort of very well-known cycles of debt distress, defaults, etc., etc. On taxonomy, I don't want to bore people a lot, but I think you're pointing to a very important problem, which is that in this green supercycle framework that we are developing, one of the political struggles that is very important, that you, Miriam, know quite well, but it's not very publicly known, is that there is a political struggle over who defines what is green, where, and how. And for the last 3 to 4 years, the European Commission within the European Union has engaged into its own political project of creating a taxonomy of sustainable finance that says these activities are green, the rest are not green, right? And the rest, if they are not green, they must be dirty one way or another. The problem with starting from green is twofold. First is that private finance will try to make green as wide as possible, and we have seen that because they've introduced additional categories of what is green, like transition activities that basically are dirty activities that can become green if the state supports them. So that's one problem, that green becomes broader and broader, which basically narrows the scope for dirty. And if you put green first rather than dirty first, I don't want to call them brown because somebody persuaded me that brown finance has a sort of racist background to it, or evokes the idea of brown as being somehow dirty and undesirable. So I'm trying to stay away from it. So if you start from green and not from dirty, then the idea is how do you promote green, not how do you penalize dirty. And if we started by basically saying these are dirty activities, these are dirty assets, these are dirty loans, these are dirty bonds, then you, as a central bank, you have the responsibility to penalize them, to make them more expensive to hold, because they are ticking time bombs on the balance sheet of financial institutions. And at the same time, within the principle of double materiality that is discussed in financial circles, they are not only ticking time bombs for financial stability, but basically they accelerate the climate crisis, right? As long as you don't penalize dirty finance, you're telling carbon financiers, go and make loans to fossil fuel companies. You will not be penalized for it. So it is a political struggle again, where we are pretty lonely in the sense of there aren't many progressive voices there, because they require now the combination of somebody who understands finance and somebody who understands environmental science. So I don't know, we probably need a green investment plan into sort of institutional capacity of civil society organizations to sort of beef up their the sheer number of people that are working on this. I'm sure BlackRock has more people working on this than the entire civil society in Europe, the US, and the Global South.
Anyway, I put in the chat the link to an explanation to start with, at least.
Okay.
Miriam, if you don't mind sharing it in the Q&A, because I think otherwise it's only the panelists who can see it. I was trying to do it by
sorry. All right, okay.
Please,
okay.
that's very helpful. Thanks, Daniela. I think I would just add to that, probably we need to add to that duopoly, third leg, which is actually understanding the productive side of all that story, because at the end of the story, this finance has to go somewhere, and some technologies will have to be applied to do that transition in productive systems and the way in which we generate, especially in developing countries, those material conditions that account for structural transformation. Let's not forget that there are countries who are still in great need of that, and that good quality economic growth, of course. Excellent. I don't see any question or raised hand. So I'll, before I give Josh, we are already finishing here. So I'll refrain myself from raising a question. I think what you raised about the China and this sort of new context in which Chinese investors are and the Chinese state is interacting with developing countries. It's not simply true alternative position in terms of but how this intersect with the political economy of these countries, right? So PPP have always been, and I've seen this working in Tanzania for quite some time, an important dimensions in terms of also the corruption of the state, in terms of creation of position of rents. And now we see how this works in different ways with the type of engagement that the Chinese state has in the context of, for example, energy or mobility infrastructures. Josh, would you like to raise one last comment before we close as our formal discussant, and then we leave Daniela just a few seconds just to final remark?
Yeah, no, really enjoyed that discussion and the presentation. I just wanted to comment actually that I've been doing quite a bit of work at IIPP on the sort of climate finance more in an advanced economy context, where this disclosure narrative is also completely dominant. And it is very clear from the fact that, for example, no central bank has created a new criteria for its asset purchases or for its collateral frameworks to exclude brown assets. That Daniela's right, that in a sense there is this overlying dominant narrative that actually the solution to the world's big problems is to enlist finance rather than for government to just go ahead and regulate and do what used to be quite simple interventions really that were widely accepted. So there is a sort of fundamental problem also in advanced economies in dealing with these issues. So thank you.
Thanks, Josh. Daniela, the last word to you for tonight, and before that, thanks again for animating this fascinating discussion.
No, just want to say thank you to the audience and to you, and thanks, Josh, for the comments and everybody for the questions. I really enjoyed this.
Thanks so much. Well, to everyone, this is going to be, as usual, recorded and uploaded in our IIPP series on YouTube. We will resume with the seminar series in the second term, and hope to see many of you again in the coming meetings. Meanwhile, have a good break.